Good morning, and thank you for joining KBRA's non-QM RMBS default study webinar. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Ratings and additional research, including our recent RMBS report, which contains a decade of non-QM default insights, can be accessed through the QR code on your screen or by visiting kbra.com. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call, so please feel free to reach out to our business development team. Now, I'd like to hand things over to our moderator, Van Hesser, for introductions.
Thank you, Michelle. Welcome, everybody. Thanks for joining us today. I'm Van Hesser, Chief Strategist at KBRA. On June 4th, our RMBS group published a study, A Decade of Insights into Non-QM Defaults. Today, we'll walk through the key findings of that report. We'll unpack attributes that drive defaults and losses in the sector, and we'll discuss what the latest vintages are telling us. So joining us today, the principal authors of that report, Jack Kahan, Senior MD and Global Head of ABS and RMBS here at KBRA, and Armine Karajyan, Senior Director in our RMBS group. Welcome to our authors here and our panelists. So let's jump right into it. Let's go to that first slide. Thank you, Jacob. Jack, we're now 17 years, I guess, past the GFC and a decade since the first non-QM securitization. Tell our listeners, one, sort of how the market has evolved and what's been behind that growth. And two, give us some dimensions over the scope and scale of the study that you've just produced.
Sure. Thanks, Van, and thanks everyone who's joined. Welcome today. So, yeah, I think probably most of the folks on the phone are generally familiar with non-QM. I won't spend a ton of time on, definitions here. The background, obviously, is that the CFPB had put out rules in 2014, had defined what a qualified mortgage is, and therefore non-qualified mortgages, what doesn't meet the qualified mortgage definition. And to summarize a whole bunch of information, because that's changed a lot over time, what that definition is, you generally have product type tests, underwriting tests, and points and fees tests that determine whether a loan would be considered non-QM or QM. There have been some changes over time on what constitutes the underwriting test. So, pre sort of the GSE patch going away, there was this idea that you had to be below a certain DTI, 43% DTI. After the patch going away and rules change, it was a APOR test that took place for the underwriting test. In the product type test, you're talking about things like whether a loan has affordability features like interest only or neg-am or balloon. And all of this is to say that there's this very, kind of strict definition around what a non-QM loan can be. But generally speaking, the market doesn't really think about non-QM loans in those aspects, principally because sometimes you can have a non-QM loan that doesn't really fit, call it what KBRA calls like a non-prime loan definition, meaning you could have a very high FICO, even a high net worth borrower that has, reasons to take out a loan that has an interest only feature, fully documented. That would technically be considered a non-QM loan, but more or less that's viewed in the market as a prime loan or in sort of prime circles, although theoretically that loan and that transaction would still be therefore a non-QM transaction. That's not what this study focused on. What we really wanted to focus on, what we call non-prime, which are, the shelves and types that folks are, used to seeing in this space. And it generally revolves around 4 different strategies as we would look at it. So one is alt-doc consumer loans. So these would be your bank statement loans, P&L, CPA letter. Another is alt-doc business purpose, which would be investor loans like DSCR underwritten or no ratio. And then, some folks who've been around this space for a while, this has generally gone away, but there were 2 other like main strategies that would constitute non-QM deals. You'd have prior credit event loans, which, back in 2015, when the market started, 15, 16, 17, you'd still have some borrowers that were coming out of, post GFC, low credit, or they would have prior credit events, meaning, not the subject mortgage that they're taking out, but on a prior mortgage, they would have had a foreclosure, a deed in lieu, some type of short sale, something like that. That has largely gone by the wayside in terms of what makes up the overall non-QM book. And then the last piece would be sort of foreign national, non-citizen, ITIN type borrowers. Those were the main strategies. As I said, when the market kind of started, you would have more in this space that was the prior credit event. Up to 15 or 20% of the market looked like that. And what we now know of the market, which is mostly alt-doc, that was only around 30% of the non-QM space at the time. And investor was around 10%. As we were leading up to COVID, the market really shifted into that, alt-doc consumer space, and that grew to around 40 or 50%. DSCR loans grew to about 20%. And then I think the market really has now coalesced into two main products. You have, investor DSCR on one side, that's now, close to 40%. And then you have the alt-doc consumer, which is 40, 50%, something like that. And you have a smattering for the remainder that goes on. So that's really what the focus was of this piece, is those type of asset classes within non-QM. And I think if we, talk about how the market's grown, what we see here on the slide, it obviously has been, pretty significant. That's why everybody's tuned into this call today. In 2018, we were under 10 billion. The asset class, definitionally started in 2014. We really saw 2018 as like the first real year of any type of issuance. And the market was really set for growth coming into 2020. Just a few short years into 2022, it had quadrupled from that 2018 state, right? Almost 50 billion, around 45 billion. Also some stumbles, as the rest of the market had, when mortgage rates had gone up. But now we've seen, issuance really, ramp back up in 24 and 25. In 25, we expect almost 60 billion in issuance. And that makes non-QM one of the largest, actually the largest RMBS 2.0 sector that we look at. So that's kind of the why we're doing this study and why I think everybody on the line has interest. I could talk a little bit, as you asked, about what the study is. So when you take all this issuance together and all the data that KBRA was able to develop through rating transactions and also get through third party, we're talking about almost 600 deals. So we were able to look at 593 deals worth of data. That's 475,000 plus loans. And Armine will speak to some of the performance of the loans in a little bit. There really have been very little in losses to speak to. So while we talk about some of the loss experience to date, the focus has been really on the default side. And what we're defining as defaults here are any loan that has ever gone 180 days delinquent, had a foreclosure, REO, or modification. So that's been the focus. If we can just flip to the next slide, just to mention the data a little bit here, if it's helpful. So you'll hear also Armine will talk a little bit more about risk layers. When we think about that issuance and looking at it on a risk profile over time, you can focus on this line that's titled WRL, weighted risk layer. And we've seen over those years that risk layering, which includes certain types of risk that are on the loan. So for example, if a loan had a FICO under 680 or a DTI over 45, if it was a cash out, an investor loan, if it had a high LTV over 80, or if it was non-full doc, so there's 6 different risk layers. You add those up on any loan, that's what that line is showing you. So on average, we started in a world of non-QM where we were closer to just having one of those risks, just over one of those risks across the pool. And we've gone over the years to a place where we have 2. I think generally what we'll discuss here is that's been relatively well managed, and we're starting to see some decrease again, a shift in 2025, but that's sort of the landscape of what we've seen in non-QM to date.
Terrific. Thanks for that, Jack. Armine, let's go to you, and we'll dig into the report a bit. What did you find that was noteworthy when we did this study?
Thanks, Van. Yeah, I guess to continue on the topic of risk layering and to sort of highlight our key findings, as Jack was saying, as the market evolves, we can see clearly that it's its product mix sort of changes and evolves. So Jacob, if we could go to the next slide, please. Well, we have then focused our initial efforts on just sort of calculating and defining default. And what we have found is that overall defaults have been very well managed. It appears that the sort of originators at their risk management have found ways to continue making these loans in this mixture of product with relatively controlled defaults. So overall, the cumulative defaults over years have reached maximum of roughly 4%. Again, that's cumulative. And that is in the height of post-pandemic stress. And then if we look at what we have on the slides here are the annual defaults by default year. I think you can sort of see clearly two trends up here going from 20 and 21 that's the post-COVID stress where your COVID delinquent loans started to show some default, and that's expected and normal, but again, under roughly around 1.5, 1.6, not very high default. So generally positive finding in that regard, even through a relatively high stress environment of COVID measured annual defaults. And then I guess the real reason and the deep dive into this sector is that if you observe that and then next ramp up 24, even 23, 24, 25, you're starting to see another ramp up in annual defaults. And this could be two factors, could be or I guess a combination of factors, macro factors, like as we know, high interest rate environment, inflation, putting pressure on borrowers in terms of expenditures. And then also you have your risk layering as well. So it's a combination of several things which led us to want to dive in deeper and deeper into some of these attributes. So if you go to the next slide, we can see here that the next view of default we're going to look at is going to be by vintage. And the interesting item here is that we have looked at default with effects of COVID and without effects of COVID. So if you look at the blue line here, that excludes COVID, and yet still you can see that there is a ramp up even without an exclusion of COVID, which is, in my opinion, in our opinion, commensurate with increase in risk layering overall. And even prior to the beginning of higher interest rates. So generally, there is an increased risk growing in the sector, like warranting us looking into it and investor interest along with its growth. But again, it's measured. So what another I would like to also point out here that while we can see that, again, these are default in vintages, so by deal vintage, while 24, 25 vintages haven't matured yet, they are actually on trend to be higher than previous years. So that's sort of the extent of our interesting findings, is that while there is somewhat an uptick in delinquencies, which is clearly observed, we have KBRA's indices that are reporting increase in delinquencies. We're also seeing defaults, but they seem to be controlled and measured. And another interesting attribute, I guess, finding was that because of how well managed or relatively well managed the risk is, when you look at attributes, loan attributes, and cohort them, it's hard to sort of find one specific variable that is, you could say, this is causing the industry to have higher defaults. And that is because they tend to be mitigated by another factor.
Armine, let me follow up on that a little bit. I think we identify or track, correct me if I'm wrong, 6 different risk layers that we've evaluated here. Which ones have you found to be the most influential?
Yes, we did do a risk layer dive, but Jacob, if you can flip onto the next slide, please. What we have found in our study, which is a comforting finding, and really is not a surprise. It's is that in line with our methodology and our expectations, we're finding that CLTV and FICO continue to be key drivers and indicators of performance. And as we can see here on this slide, for CLTV, we chose to do a slightly different take and a deeper dive to exclude the cash outs in a sense to just provide deeper granularity and maybe a little bit more zoned in look at the correlation and relationship here, simply because the home prices have been consistently high even throughout COVID, historically high levels, in that almost like a benign environment, making CLTV, while again, it's showing still marked correlation. You can see where your CLTV is lower, you have lower defaults, and in the higher CLTV buckets, you have higher defaults. If we switch to the next slide for FICO, you could see that the negative correlation here is much stronger and more clearly visible. And that is, again, because in an environment where housing prices are stable or growing, the borrower credit or score becomes a stronger variable that indicates performance. And so a couple of interesting observations here are, first of all, you can see that bulk of our number of loans here, which are the diamond-shaped blue items, are the number of loans in those buckets, is generally clustered around higher FICO scores. So there's definitely a positive FICO drift towards higher FICOs. That could indicate two things. One, that the FICO scores are potentially inflated, and two, that the credit profile of the borrower is getting higher and better, which with or without regards to the notion of potentially inflated FICO scores, you're still seeing a direct correlation here, like a negative strong correlation. So those two, credit and FICO, continue to be the main drivers of default. Again, great news for us. Our methodology and our model heavily relies on these, and I'm sure same is true for others. So those are the ones. And then if we were to specifically think about more non-QM factors, if we go to the next slide, this is where sort of a bread and butter of non-QM sector is. I want to bring your attention to the fact that we have now moved on to the KBRA universe of population. So earlier, Jack described our population, and the nuance of this information, and we spend a lot of time in our study discussing this, is that this loan documentation type is not necessarily readily available and uniform throughout the industry. So we were able to gather this information through our ratings process, and we have a vast number of observations, large enough to be, I think, show some very meaningful results here. And one clear finding here is that full doc, as in tax return W-2 on this chart, are lower than, like, the defaults are lower than the other non-full doc types. But I think another also meaningful observation is that the default is not that much lower when you compare to DSCR loans or bank statement loans. And that is because what we find is, for example, DSCR no ratio loans have one of the lowest CLTVs in their cohort. I think CLTV in this bucket was like 66.6, and FICO was 744. So you could see how lenders are managing risk, and this chart is a great example of that. Another unique finding of this subset of doc type analysis was that we're seeing that WVOE and asset underwriting are actually performing better than full doc. But again, we do have much lower number of observations in this, as you could see, and potential explanation for WVOE having lower defaults could be the rigor of that form. That's a GSE form that somewhat resembles a tax return, or very much so requires like a very rigorous verification of income. So we think that could be one of the explanations. As Jack was saying earlier, DSCR no ratio are the growing segment of this population. It's maybe the most I would think a lot of our callers are interested in this segment. We see a lot of deals being done specifically for just DSCR loans. So if we flip to the next slide, please. You can see here that we've looked at now, again, a separate subset of just the DSCR loans. So this is a subset of a subset. So we're looking at the small number of observations, but again, still a high and statistically significant number of KBRA rated transactions again. And I think that this is also a very interesting chart, in that you could see that all of your, not all, but a lot of, a good portion of your loans is clustered between 1 and 1.5 DSCR. And the performance, as in the default, is fairly stable across those three DSCRs. And then as you sort of go to one end and the other end, you see a more variation. And of course, for no ratio loans, you see the highest default, again, with the lower number of observations, but absolutely makes sense for those to have higher defaults. And the growth of this sector could be supported again by higher rents, availability of Airbnbs, etc. So we think it's very important to continue evaluating the defaults in this space. But as it is, it seems to be, the defaults seem to be measured. And finally, to get to your actual question about risk layering, if we move on to the slide on this. So these were the attributes you were asking about, Van. So we have borrowed this concept of risk layering from the GSEs. GSE data dynamics tool, and has a similar, but a similar concept for their tool, and we have used it successfully prior in our analysis before. So we had this idea to develop this risk layering for non-QM, and so we came up with these 6 attributes that we thought would be most interesting to look at in terms of higher risk. So FICO below 680, DTI higher than 45, loan purpose cash out, occupancy investor, CLTV 80 and higher, and most importantly, documentation not full. And here there's direct correlation, fairly obvious, and that should be the case. It's also a positive finding that we're seeing that most observations are clustered between 2 and 3. That also ties with our finding by vintage. You could see a very, very small number of observations in risk layers 5 and 6. So overall, this is a good slide to sort of like a pulse of non-QM market, a good way to have a quick snapshot of where the risk attributes are. And we have had significant amount of interest in this particular metric, both in our previous pieces and in this one. So we wanted to highlight it again.
Yeah, thank you for that. I mean, that was a very thorough review, I think, of all of the trends that we're seeing in these various risk factors. If we pull back for a second and think about the environment, clearly we had the shock of COVID, and that was very influential in ways I think that we've shown. But in general, the environment has been fairly good, x that couple of months, a quarter or so of COVID. Um, I think market consensus now being for modest stagflation, below potential, but still positive economic growth, sticky high inflation running a touch above target. How do we expect the non-QM market to perform under this scenario? Jack, what are your thoughts?
I think there are two things I would note. So when you talk about, inflation and where unemployment are and the types of observations that we've had about, performance of non-QM under these varying macro environments, I think that what you'll find, and this is true, across much of the consumer space, is that you tend to still have borrowers that are stretched in this scenario. So while the growth of inflation has slowed, we're still in an environment where you are inflated after years of having essentially a cost of living crisis, and so that still weighs on these borrowers as well as other borrowers. Some of the listeners, especially the originators, might have bristled when KBRA calls this like a non-prime segment, and by that we just mean sort of more like non-conforming, non-jumbo. Most of these borrowers, though, case in point for our default study, the average borrower in this space had 735 FICO. That is a prime FICO, and many of the transactions that we rate are 740 or even 750 weighted average. Those borrowers, generally will tend to be more insulated, but you have to think about what's going on in this space. Like I said, the non-QM arena is really a investor loan book, and it's a alt consumer doc, which really mostly means self-employed borrowers. And so where are they going to be most exposed? And in both of those pockets, you can be pretty well exposed to something like an increase in inflation, increase in cost of living, because on the investor side, you're thinking about who your renters are, what your cash flow is on those properties. And, Armine mentioned some short-term rental exposure, which is relatively low in these buckets. It tends to be more, annual lease, but there is going to be less demand likely on that side from a short-term rental perspective. So that's going to weigh on things. On annual leases, rents have gone up, and that will continue to, on one hand, support DSCR, on the other hand, potentially, create payment problems for the underlying tenants. For the alt doc consumer, again, if spending comes down because prices are up, that self-employed borrower might find themselves in an area where they're more pressured on the income for, whatever their business is, which tend to be diverse. So you do still see pressure in this space. And I think one of the questions will be, if we've seen the 22 and 23, and to an extent 24 vintage have higher risk layering, relative to where the market was before, and these borrowers are stressed, are we going to see originators and underwriters start pulling in on some of these risks? Because I do think that the environment is still choppy for these borrowers.
Yeah, so let's explore a little bit of that. If we think about sort of what we've come through, the growth of the market, into some of these headwinds, still continues to be fairly strong. How would you sort of characterize the risk appetite of underwriters? Is it, I know we've sort of looked at the average kinds of numbers. Is there a fair dispersion of risk behavior underwriting among sort of lenders out there?
I would say so, although I would say, like, across shelves, the performance hasn't been, widely divergent. Armine mentioned earlier that, we've been in this environment that has been a home price up environment for over a decade, and in some of those years, considerable home price increase. So, you do have kind of a flattening of the, you still see the importance of CLTV and equity in property, that more so than anything in the loss versus, the fact that we have had virtually zero losses in this space. So that really has pushed things onto FICO. Like, is this just a borrower who has a willingness to pay more than kind of stressed on the ability to repay side of things? And so you've had considerable equity. You haven't really had that kind of stress level. And so when you think about, originators and underwriters, I think there's sort of two schools of thought. One is if you take a really broad view of this market, when you compare it to, pre-crisis, which may be unfair and kind of a low bar, and this is true actually across the mortgage space, but it's also true in non-QM, there's probably, some amount of room for underwriting to continue to loosen. Like there would be some discussions about how tight underwriting remains on a historical context, and that can widen to some level. Not every loan that's made is made to, not default, right? That you are going to have some loans default in any population. I think the other school of thought is what we were showing kind of in the history of what we've seen. Hey, let's take a beat. Let's look at, some data-driven approach to what's happening for the underwriting that we're doing. We have definitely seen those risk layers increase. And now what are we seeing on the default side? And we are seeing the defaults go up. So do we have to take a step back and say, okay, where do we need to pull back on the underwriting, make sure that we have, our risks covered off here? And we do also hear that from underwriters and originators, and we see that in the data. You'll see things like the FICO scores coming up over the last, 6 months or so, or even the last 18 months, really, from kind of lows that we hit through 2022. So you do see some recognition of the fact that there's still stress in the environment and that there's ways to pull levers on underwriting to try to amend that. And I think, frankly, there's still a good amount of room to run in the non-QM space in terms of issuance volume and origination volume. And it seems that originators and issuers are fairly committed to this space right now, so are acting in a prudent manner, largely speaking.
Yeah, I was going to say, Jack, if we think about the market, maybe correcting, maybe that's too strong a word, but clearly you've had the strong rise in home values. How do you factor that into or a possible correction? How does that factor into what we're seeing or what we expect to see in sort of the non-QM market going forward?
Yeah, I mean, I think I think for us, when we're rating, we're applying our rating methodology. It's a methodology that we had updated in late 23. I think a lot of the work that we're seeing through this default study very much correlates with the methodology that we currently apply. I think that we are, from a macro perspective, we're on a home price, standpoint, we still have that supply and demand imbalance, which means that, on a national level, we're probably still, good treading water on home prices, maybe up nationally, small, single digits. So it's not as if we see a, major downturn on the horizon for home prices, which will, be constructive for this space. But notwithstanding home prices, as you alluded to, we continue to have kind of inflationary pressures, may have more of those in the future. So I think for us, when we're rating transactions, this continues to be a time where you need to really pay attention. We were always paying attention, and market participants who are on phone, I'm sure always have been. But over the last couple of years, when you had 20% home price increase, that gives you a lot of leeway, right, to make various calls on underwriting, and that leeway is gone. So now is definitely the time to, really pay attention to what's going on in these markets.
All right. So with that, I think we'll conclude our formal remarks here. We can open it up to Q&A. I'll remind folks that you can submit a question via the chat function on the bottom of your screen. Let me go to our first question here for either Jack or Armine. Thank you for the great content. We always like the plug. Focusing on the 22 to 24 vintages, any specific regions that are of focus for performance deterioration, i.e. areas with higher DSCR concentrations?
Well, yeah, I'm not sure if this question means geographic regions or just regions of space. I'm interpreting kind of as geographic regions.
Yeah, I would think that's
yeah.
about.
So, you know, I think we definitely, you know, I was in my prior remarks, I was talking about national home price changes. I mean, there definitely are areas where you have had, you know, yes, there are areas that have had higher levels of both DSCR, investor, and short-term rental properties that are areas that are, as I mentioned before, you're likely to see or have seen a decrease in demand for, you know, short-term rental properties, and I think that will weigh on the performance of those loans in that space. I forget which slide it is. If we flip back to the DSCR slide, maybe it's slide 10. Guess, Jacob, if you can flip back. You know, what you really see is that on the DSCR, so yeah, thank you. Oh, it was 12. Just this one before. Yep, you're there. So, you know, you really did see that underperformance of the no ratio and low DSCR loans. And so the areas of the country that have had these properties that, you know, maybe they have short-term rental, which in the past, honestly, have had some of the higher DSCRs because the, you know, rent prices you can get on a short-term rental tend to be higher, although we would classify those based on sort of an annual run rate of rent. Sorry, go back to slide 12. You know, you are definitely seeing some deterioration in those areas, and that will also flow through to the home prices in those areas. So we see that in some areas like you know, across Florida, which has other issues relating to you know, insurance rates. There were some areas in Texas that have, you know, come down, and these are, you know, sort of global factors, not necessarily national factors, not necessarily related to DSCR, but even some of the moves that were happening, you know, post-COVID in terms of where people move to, and then, you know, there's back to office and there's come out. So we've definitely seen some geographic changes where home prices on a local level remain depressed, and that will impact the performance in those areas.
And if
All right.
we look at our observations that we have in our study, like if we look at that chart that we have disclosed in for the defaults by state, I would say that, Jack, what you were saying ties to the data as well. Because, for example, I'm looking at Florida column here that has a high number of observations and high default for like, not high, but, you know, like higher, for example. Whereas if we look at California, has a high number of observations and lower defaults than Florida. So it's certainly very much, those two states are top of the mind, I think, for people because of fires in California and floods in Florida. So those two, though, like still under 5. So if we look at Florida is roughly around 4.2, and California is maybe 3.5 for defaults, with both with high number of observations and high number of loans. And
All right, another audience question here. We've begun to notice elevated delinquencies in higher balance loans, particularly owner-occupied loans. Any thoughts here?
Yeah, we definitely we saw this. We covered this in the default study. Actually, we looked at the balance of loans, and you see almost like a barbell effect, actually. So, which, you know, I think is fairly well able to explain. And in the higher end, you definitely see that. I don't know if it was so much borrowers that were taking out, you know, high balance loans and thought they could refi, but I do think that if you did take out a high balance loan and you're looking at and you find yourself in some sort of stress and you're looking at refi as a solution, that becomes doubly a problem because of the debt burden of refining a much larger loan balance. And so we definitely did see higher default risk on higher balance loans in the non-QM space. And I think the person who submitted the question also noted that this is particularly in owner-occupied loans. We definitely see that as well, that's the case. So I think the issue is higher debt burden, more stress in the system. That dollar amount that comes with your, you know, higher payment, especially if you're looking at refi as an option, probably goes away. And by the way, I should say, most of what's happening in the non-QM space, you have the underwriting picture, and it's an important picture when we talk about the risk layers. But we have also been operating for, you know, quite a while now, two plus years in a very low prepayment environment. So, you know, borrowers definitely are not just under some stress based on where the macro environment is, but you have to sit with this loan in that stress for much longer because prepays are no longer 20 or 30%. They were, you know, they were sub 10%. Now we're at, you know, 10 to 15%.
Okay, another question. The study shows a steep inverse relationship between credit scores and default rates. Are you seeing a shift towards higher FICO borrowers recently?
Yes, we definitely are. I think I've highlighted highlighted it previously, but yes, we certainly are. And even in our study, we've even done that cut where we look at a FICO and CLTV in the same vintage range, if that makes sense. And we're seeing that it's sort of like an X in terms of graphical visualization. So you're seeing your FICOs are going up and your CLTVs are going down. So overall borrower quality is increasing, but also just FICO score as a number is also increasing as a weighted average over the years.
Yeah, I think if I remember that in the 22 vintage, on average, I think we were seeing FICO scores down closer to that 730 mark, maybe 735. And, you know, again, 22, 23 vintage were, you know, some of the more problematic in terms of what we're observing in the defaults. That has definitely risen up through 2024 and 2025. That weighted average FICO scores now approach 745 to 750. So and that's an average, right? So you're talking about probably cutting out some of the bottom of that piece. So yes, FICO has been really consequential, and we've seen a meaningful shift back to quality there.
All right, maybe a final question here. Given delinquencies have increased of late, are you seeing that reflected in new issuance, credit enhancement, or rating actions in your surveillance?
Yeah, I think I mentioned this before too, Van. You know, one thing I'd want to say about this is in new issuance, yes and no. You know, you have opposing forces here. One is it's kind of true across the board that we have seen some pullback in underwriting, you know, a little bit of a flight to quality. And so as, you know, as our model goes and we're looking at, you know, non-QM deals today, we do see credit enhancement has come in, and to some extent that is commensurate with the you know, with the performance metrics that we're seeing, with the collateral metrics that we're seeing, excuse me, you know, FICO's, you know, going higher, some CLTV pullback. So we do see that credit enhancement has come in the lower parts of the non-QM stack that rely on excess spread. Over the last year, there has been more excess spread in transactions. So we have seen that come in as well. So that's one piece of the puzzle. The pushback on that is, well, obviously we've seen some increase in, you know, these default performance metrics, and so that's something you'll have to take into account. The extent to which the credit enhancement has moved on new issue transactions has been, I think, a little bit more on, you know, some transactions than, you know, what KBRA is seeing in our model. That may be a result of the competitive environment in you know, the transactions that are out there. What we're seeing is there has been some pullback. It is in part related to the fact that there has been a flight to quality and collateral. On surveillance, the good news there is that the structures have been such that even with the increase in delinquencies and defaults we're seeing, losses have been, you know, really low. They've been essentially zero. And, you know, LTVs are such that you're continuing to be in a position for somewhat low losses unless and until home prices really take a turnaround. And so predominantly in surveillance, we still see, you know, mainly affirmations and some, you know, upgrades in the earlier vintages.
All right. I think let's end it there. Very productive, very interesting 45 minutes. Jack, how can listeners find out more information about the work that your group does?
All of this information is on the KBRA website through KBRA Premium. You can access all that information there. You can always call myself or Armine or anyone on the RMBS group. We're happy to pick up the phone and chat more about any of these questions that folks might have. So really appreciate everybody tuning in to this. Thank you.